What separates the men who build real fortunes in the market from those who eventually walk away with empty pockets is not intelligence, and it is not even luck. Luck certainly plays a role when a trader happens to be positioned correctly at the right moment, but luck alone has never sustained success. The real difference lies in something far more difficult to master: the discipline to remain inactive when there is nothing worth doing. Most people enter the market believing that constant action leads to profits. They think success comes from always being involved, always placing trades, always reacting to every small movement in price. But the truth is the opposite. The market rewards patience far more than activity. The ability to sit quietly, observe, and wait for the right moment is the skill that separates professionals from gamblers. Early in my career, I did not understand this lesson. Like many beginners, I believed that every opportunity had to be seized immediately. I felt that if I was not trading, I was somehow falling behind. That belief cost me a great deal of money before I realized the truth the market was trying to teach me. When I first started working around markets, I had a natural sense for numbers. Patterns in price movements seemed obvious to me while others saw nothing but confusion. I could read the behavior of the tape with surprising accuracy. As a young trader, this ability gave me a dangerous kind of confidence. By the time I was still very young, I was already making more money than many grown men who had families to support. That early success convinced me that I had mastered the game. I believed I understood the market completely, but success without discipline is a fragile thing. In those early days, I thought that being correct about the direction of a stock was all that mattered. If I believed a stock would rise, I would buy it. If I believed it would fall, I would short it. The problem was that I did not yet understand the importance of timing. Being right about direction means nothing if your timing is wrong. A trader can correctly predict where a stock will eventually go and still lose money if he enters the trade too early or exits too late. The market moves according to its own rhythm. It does not follow anyone's predictions or opinions. No matter how convincing your analysis may be, the market will move when it is ready to move. There was a time early in my career when I became convinced that the market was approaching a major decline. Everything I studied suggested that prices were about to collapse. My analysis was correct in the long term, but I acted too soon. I began selling short far earlier than I should have. As the market continued rising, I continued adding to my short positions, believing that the reversal must come soon. Instead of waiting for confirmation, I relied entirely on my expectations. The result was predictable. The market kept climbing while my account slowly drained. Day after day, I watched losses accumulate, all while believing that I was ultimately right. The experience was frustrating beyond words. I knew the direction of the move, yet I was losing money. Eventually, the market did crash exactly as I had anticipated. But by that time, most of my positions had already been forced out by losses. Being too early in trading is the same as being wrong. That painful experience taught me something that no book or lecture could ever teach. A trader must allow the market to confirm his ideas before committing serious capital. Acting purely on belief is dangerous. Acting on evidence is the foundation of successful trading. Patience is not simply a virtue in trading. It is a requirement. Many traders approach the market the way gamblers approach a slot machine. They feel the need to pull the lever constantly. They want excitement, movement, and action. Sitting still feels uncomfortable to them, as if they are missing opportunities. But the professional trader understands something very different. The professional waits. Sometimes that waiting lasts for days. Sometimes it lasts for weeks, or even months. During that time, the trader observes, studies, and prepares. Capital is treated like ammunition, and ammunition is never wasted on uncertain targets. When the right opportunity finally appears, the disciplined trader acts decisively, but until that moment arrives, patience remains the most valuable skill he possesses. The market will always provide new opportunities. There will always be another trade tomorrow, next week, or next year. Opportunities are endless, but capital is not. Once money is lost, it is gone. Even more damaging than financial loss is the loss of confidence that follows repeated mistakes. Trading is as much a psychological game as it is a financial one. Every loss affects the mind of the trader. Doubt begins to grow. Judgment becomes clouded. Emotions replace clear thinking. When that happens, even good opportunities are often mishandled. For this reason, protecting both financial capital and mental capital becomes essential. One practice that helped me enormously was keeping detailed records of my trades, not just the numbers, but the reasoning behind each decision. I wrote down why I entered a position, what I expected to happen, and what actually occurred afterward. Reviewing those records forced me to confront my mistakes honestly. It became impossible to hide from my own errors when they were written clearly in front of me. In trading, honesty with oneself is priceless. Without it, improvement is impossible. The market does not care about anyone's hopes, fears, or expectations. A stock does not know that you owe and it certainly does not feel any obligation to reward your patience. Prices move according to supply and demand. Buyers push prices higher. Sellers push prices lower. Everything else is merely explanation after the fact. A trader's job is not to predict the future with certainty, but to observe what the market is actually doing and respond accordingly. Those who understand this principle eventually learn to move with the market rather than fighting against it. And in the long run, that simple shift in mindset makes all the difference between survival and failure. The market does not reward opinions. It rewards observation and discipline. Many traders spend endless hours forming theories about what should happen, but the market is not concerned with what anyone believes should occur. It simply moves according to the forces of supply and demand, shaped by human emotions that have remained unchanged for centuries. Fear and greed have always driven the market, and they always will. The technology may change, the companies may change, and the tools available to traders may evolve, but human nature remains constant. Because of this, price behavior tends to repeat itself over time. Patterns emerge again and again, not because markets are predictable machines, but because people react to uncertainty in familiar ways. Understanding this reality changes the way a trader approaches the market. Instead of attempting to outsmart it with clever predictions, the wise trader focuses on reading what the market is already revealing. Every movement in price contains information. Every shift in volume suggests the presence of buyers or sellers gaining control. A trader who learns to observe these signals develops an advantage that no rumor, tip, or news headline can provide. Throughout my career, I discovered that the most reliable information always came from the market itself. Desk papers often reported events after the market had already reacted. Financial commentators frequently explained movements only after they occurred. By the time the public understood the story, the opportunity had usually passed. Watching price action directly was far more valuable. When a stock begins rising steadily while the broader market struggles, it often signals hidden strength. When a stock weakens despite positive news, it suggests that large holders may already be distributing shares. These clues appear quietly in the movement of price long before they become obvious to the public. Learning to recognize these signals requires patience and experience. It cannot be mastered overnight. Many traders enter the market expecting quick results. They believe that success will come within weeks or months. When early trades fail, frustration sets in. Some abandon the market entirely, while others begin taking reckless risks in an attempt to recover their losses quickly. Both reactions are dangerous. Trading is a profession that demands long periods of learning and self-development. Mistakes are inevitable during that process. What matters is not avoiding every loss, but learning from each one. In my own career, I experienced failure more than once. There were times when I built fortunes and later watched them disappear. Each of those experiences taught me something essential about the market and about myself. The first time I suffered major losses, I blamed everything except my own decisions. I blamed manipulation, bad luck, and circumstances beyond my control. It was easier to believe that outside forces had caused my losses than to admit that I had made mistakes. But the market does not care about excuses. Eventually, I began to recognize that the common factor in every losing situation was my own behavior. I had ignored warning signs. I had acted too quickly. I had allowed emotions to override discipline. That realization was uncomfortable, but it was necessary. The third time I faced serious losses, I finally understood the real problem. I had abandoned the very rules that had previously made me successful. Instead of following my method carefully, I allowed impatience and confidence to lead me into trades that did not meet my own standards. Breaking your own rules is one of the most expensive mistakes a trader can make. There is a phrase that has cost traders enormous amounts of money over the years. This time is different. Those 4 words have destroyed more trading accounts than almost any other belief. Whenever traders convince themselves that the normal rules no longer apply, they expose themselves to unnecessary risk. They begin holding losing positions longer than they should. They stop using protective stops. They average down in hopes that a falling stock will recover. Every one of those actions is rooted in the same dangerous assumption that the market must eventually prove them right. But the market is never wrong. If a stock moves against you, the market is providing information. It is telling you that your analysis, timing, or interpretation was incorrect. The sooner that information is accepted, the sooner corrective action can be taken. Resisting that message only increases the damage. Successful traders develop the habit of respecting the market's verdict. When price action contradicts their expectations, they adjust quickly. Pride has no place in trading. The market does not reward stubbornness. One technique that helped me stay aligned with the market was focusing on what I called pivotal points. These were moments when a stock broke through an important level of resistance or support with convincing strength. Such movements often indicated that large participants were committing serious capital. When a stock breaks above resistance with strong demand, it suggests that buyers are confident and willing to push prices higher. When a stock falls below support with heavy selling pressure, it signals that sellers are gaining control. Rather than trying to predict these moments, I waited for them to occur. Many traders attempt to pick exact tops and bottoms, believing that entering at the perfect moment will maximize profits. In reality, this approach often leads to unnecessary losses because predicting precise turning points is extremely difficult. Waiting for confirmation may mean entering a trade slightly later, but it dramatically increases the probability that the market is moving in the expected direction. Once confirmation appears, the trader can participate with greater confidence. Another critical concept that many traders misunderstand is position size. Not every trade deserves the same level of commitment. Some setups are weak or uncertain, while others present strong evidence that a significant move may be developing. Treating all trades equally ignores this reality. Professional traders adjust their position sizes according to the strength of the opportunity. When the conditions are unclear, they trade small or remain out of the market entirely. When everything aligns, clear patterns, strong momentum, and favorable market conditions, they commit more capital. This approach allows profits from strong trades to outweigh the small losses that naturally occur during uncertain periods. Of course, this strategy only works if discipline remains intact. Large positions must only be taken when the evidence truly supports them. Otherwise, the risk becomes excessive. Over time, I realized that trading success is not built on constant activity. It is built on a small number of well-timed decisions made with patience and confidence. The market offers endless distractions, but only a few moments truly matter. The trader who learns to recognize those moments and act decisively when they appear places himself in a position to achieve lasting success. One of the most important truths about the market is that real wealth is built during rare moments of extraordinary opportunity. These moments do not appear every day, and they certainly do not appear every week. Sometimes months pass with nothing worth acting on. Occasionally, even years can go by without a truly exceptional setup. This reality frustrates many traders because it contradicts the belly, if that money must be made constantly. In reality, the greatest gains often come from a handful of well-timed decisions rather than from continuous activity. The disciplined trader understands this and prepares accordingly. Instead of chasing every small fluctuation in price, he preserves his capital and waits for conditions that strongly favor success. When those conditions finally appear, he is ready both financially and mentally to take advantage of them. But preparation is only half of the equation. The other half is courage. When the perfect opportunity arrives, hesitation can be just as damaging as recklessness. Many traders spend months waiting for the right setup. Yet when it finally appears, they become afraid to act decisively. Past losses or fear of being wrong again cause them to enter timidly or not at all. Professional trading requires a balance between patience and boldness. You must be patient enough to wait for the right moment and bold enough to act when that moment arrives. During one of the most dramatic periods in financial history, I witnessed the market forming exactly such an opportunity. Conditions across the financial system were weakening, and price behavior was revealing growing instability beneath the surface. Stocks that had once risen effortlessly began struggling to hold their gains. To those who were carefully watching the market's behavior, the warning signs were becoming increasingly clear. When the collapse finally began, it unfolded with enormous force. Prices fell rapidly as fear spread through the market. Many investors who had believed the boom would continue indefinitely suddenly realized that they had misunderstood the situation. While others were reacting in panic, traders who had studied the warning signs were positioned to benefit from the decline. Short selling during that period produced extraordinary profits for those who had prepared themselves in advance. But the profits that come from such moments can create their own dangers. Success often leads to overconfidence. After experiencing a major victory, many traders begin believing that they have mastered the market completely. They increase their risks, loosen their discipline, and assume that future trades will work just as easily as the last one. This mindset is extremely dangerous. The market has a way of humbling anyone who begins to feel invincible. Conditions change constantly, and strategies that worked in one environment may fail in another. Confidence is necessary, but arrogance can quickly destroy years of hard-earned gains. In my own experience, I eventually learned that building wealth and preserving wealth require slightly different mindsets. Building wealth often demands aggression. When the opportunity is clear and the odds are strongly favorable, the trader must be willing to commit significant capital. Without that willingness, the rewards of major market moves cannot be fully captured. Preserving wealth, however, demands caution. Once a trader has accumulated significant profits, protecting those gains becomes just as important as generating new ones. This requires restraint, discipline, and the ability to step away from the market when conditions become uncertain. Many traders fail at this stage because they continue behaving as if every trade must produce another dramatic success. They ignore risks that they would have respected earlier in their careers. Eventually, the market punishes that complacency. Another area where traders often struggle is in their relationship with losses. Losses are an unavoidable part of trading. Even the most skilled traders experience them regularly. The difference between successful traders and unsuccessful ones lies in how they respond to those losses. The inexperienced trader views a loss as a personal failure. Pride becomes involved. Instead of accepting the mistake and moving on, the trader begins searching for ways to recover the lost money immediately. This emotional reaction leads to poor decisions. A trader who refuses to accept a loss may hold a losing position far longer than he should. He may even add more capital to the trade, in hopes that the price will eventually reverse. This behavior, commonly known as averaging down, often turns small losses into devastating ones. Professional traders approach losses differently. To them, a loss is simply information. It is feedback from the market indicating that something about their original judgment was incorrect. Perhaps the timing was wrong. Perhaps the pattern they believed they saw was not as strong as they assumed. Whatever the reason, the loss provides valuable data. By studying that data carefully, the trader can refine his methods and avoid repeating the same mistake in the future. In this way, losses become part of the learning process rather than a source of emotional damage. For this reason, I developed a strict rule regarding positions that did not behave as expected. When I entered a trade, I already had a clear idea of how the stock should behave if my analysis was correct. If the stock failed to act according to that expectation, I exited the position quickly. I did not wait endlessly hoping for the market to change its mind. If a stock showed weakness when strength was expected, that was enough evidence for me to reconsider the trade. It is far better to exit a position early and reassess the situation than to remain trapped in a losing trade while hoping for a reversal. Capital is the lifeblood of every trader. Without it, there can be no future opportunities. Protecting that capital must always remain the highest priority. There is also another form of capital that traders rare, the ID discuss, but which is equally important. Mental capital. Mental capital. Mental capital represents the clarity, confidence, and emotional stability required to make sound decisions. Every stressful trade, every large loss, and every moment of panic reduces this mental reserve. When a trader becomes emotionally exhausted, his judgment suffers. He may begin forcing trades, ignoring risks, or acting impulsively. These behaviors quickly compound the damage already done. Maintaining mental balance is therefore essential. This is why experienced traders sometimes step away from the market entirely after a series of difficult trades. A short period of rest can restore clarity and prevent further mistakes. Trading is not simply about analyzing charts. Trading is not simply about analyzing charts or studying financial reports. It is also about managing one's own emotions under pressure. Those who master both aspects, the analytical and the psychological, place themselves in the strongest position to succeed over the long term. And in the world of trading, long-term survival is the true measure of success. Another reality that every trader must eventually accept is the role that luck and timing play in this business. Some people dislike admitting it, but luck is part of every successful career in the market. Being born at the right time, entering the market during periods of strong volatility, or encountering the right mentors can create advantages that cannot be ignored. However, luck alone explains very little. Many people experience fortunate circumstances and still fail to build lasting success. Others begin with almost nothing and slowly develop the discipline required to thrive. What truly matters is how a trader responds when opportunity appears. Every profitable trade creates an advantage. That advantage can be compounded through discipline and patience, or it can be wasted through carelessness. The traders who succeed over long periods are those who protect their gains and build upon them step by step. Maximizing profits while minimizing losses sounds simple when stated in theory, but in practice it demands tremendous emotional control. Consider the situation when a trader holds a winning position. The price has moved significantly in his favor. Perhaps the stock has risen 50% or even doubled in value. At that moment, a powerful fear begins to appear. The trader begins thinking about how quickly profits can disappear. He imagines the market reversing suddenly and erasing everything he has gained. That fear creates an intense urge to close the trade immediately and secure the profit. Sometimes taking profits early is reasonable, but often this instinct prevents traders from capturing the full potential of a strong trend. A truly powerful move in the market rarely ends after a small advance. Stocks that show real strength often continue rising far longer than most traders expect. The challenge is allowing those winners to develop without interfering too early. Successful traders learn to resist the temptation to close strong positions prematurely. As long as the stock continues behaving correctly, holding its trend, attracting buyers, and demonstrating strength, it deserves the opportunity to continue moving. In some situations, traders may even add to winning positions when the market confirms the strength of the trend. This strategy allows profits to grow exponentially during powerful market moves. Yet the psychological challenge becomes even greater when dealing with losing trades. When a position begins to move against the trader, the natural instinct is to hope that the price will eventually recover. The trader may think that the decline is temporary and that patience will allow the stock to return to its original level. Hope, however, is not a strategy. While a trader waits for a losing position to recover, valuable capital becomes trapped in a trade that is not working. Even worse, the emotional burden of that losing trade begins to influence other decisions. The mind becomes distracted. Instead of focusing on new opportunities, the trader constantly checks the losing position, hoping for signs of recovery. This mental pressure often leads to additional mistakes. For this reason, disciplined traders follow a simple principle. Losses must be controlled quickly. Small losses are manageable. Large losses can destroy an account and a trader's confidence. Whenever a position proves to be incorrect, exiting the trade allows the trader to preserve both financial and mental capital. There is a question that traders should ask themselves whenever they are holding a losing position. If I did not already own this stock, would I buy it at this price today? If the answer is no, then holding the position rarely makes sense. The market does not care about the price at which you originally entered the trade. The only price that matters is the current one. Accepting this truth allows traders to move forward without emotional attachment to their past decisions. Over time, most traders learn that the market acts as a relentless teacher. Every mistake carries a financial consequence. Every violation of discipline eventually leads to losses. In this sense, traders pay tuition to the market. Those early losses become part of their education. The key is ensuring that the tuition remains affordable. A trader who risks too much capital early in his career may lose everything before he has the chance to learn the necessary lessons. But a trader who keeps losses small can survive long enough to improve his skills. Survival is the first goal in trading. Once a trader remains in the game long enough, patterns begin to reveal themselves. The movements of price start to fade. Familiar market cycles become easier to recognize. With experience comes a deeper understanding of rhythm, how markets expand and contract, how optimism turns into fear, and how trends eventually exhaust themselves. But even after reaching this stage, the dangers do not disappear. Success can create a dangerous illusion of mastery. A trader who experiences several profitable trades in a row may begin believing that he cannot make mistakes. That belief often leads to reckless decisions. The market has a way of correcting such arrogance quickly. The wiser approach is to respect the market at all times. It should be treated with the same caution one would show toward powerful natural forces. A person may learn to navigate the ocean, read the tides, and travel safely across its surface. But no sailor ever truly conquers the sea. The ocean simply allows passage to those who respect its power. The market operates in much the same way. Those who approach it with discipline, humility, and patience can benefit from its opportunities. Those who approach it carelessly eventually discover how unforgiving it can be. Trading must therefore be treated as a serious profession. It requires continuous study, careful observation, and emotional discipline. Traders must develop a structured method for identifying opportunities and managing risk. They must record their decisions and analyze their mistakes honestly. Without this level of commitment, long-term success is unlikely. Honesty with oneself remains the most valuable quality a trader can possess. When trades fail, blaming external factors provides no improvement. Real progress begins only when traders examine their own decisions critically. Similarly, when trades succeed, it is wise to consider whether skill or favorable circumstances contributed to the result. Understanding that difference prevents overconfidence and encourages continued discipline. The market will always offer opportunities to those prepared to recognize them. Human behavior continues to drive price movements, just as it did generations ago. Fear still pushes traders to sell at the worst possible moment. Greed still encourages others to buy near the top of powerful trends. These emotional cycles ensure that opportunities never disappear completely. The trader's objective is simple: remain disciplined enough to take advantage of those cycles, rather than becoming a victim of them. Patience, preparation, and emotional control allow traders to place themselves among those who consistently benefit from the market, rather than those who repeatedly lose to it. The opportunity for success is always present, but only for those who approach the market with respect and discipline. The next great opportunity will eventually arrive, just as it always has. Just as it always has. When that moment appears, the traders who have protected their capital, sharpened their judgment, and maintained their patience will be ready. And in that moment, preparation will finally meet opportunity. The market does not announce when the next great opportunity will arrive. It does not send invitations, and it does not reward those who are unprepared. Opportunities appear quietly, often when the majority of participants are distracted, fearful, or overly confident. Only those who have trained themselves to observe carefully and act with discipline are able to recognize these moments. This is why preparation is everything. A trader who spends years studying the behavior of markets, learning from mistakes, and refining his methods slowly builds an internal understanding that cannot be rushed. Patterns begin to stand out. Movements that once seemed random start to make sense. The market begins to speak a language that only experience can teach. When that understanding develops, confidence, follows, but it must remain controlled confidence. The moment a trader begins believing that he cannot be wrong, he places himself in danger again. The most successful traders remain students of the market for their entire lives. They never assume that they have mastered it completely. Instead, they continue observing, learning and adjusting as conditions evolve. Markets change, but the psychology behind them remains remarkably consistent. Human emotions, fear, greed, hope, and panic continue to shape price movements just as they always have. Because of this, the core principles of disciplined trading remain valid, regardless of the era. A trader who respects risk, protects capital, and waits patiently for strong opportunities will always possess an advantage over those who trade impulsively. The difference between success and failure rarely comes from a single decision. It is usually the result of hundreds of small choices made over time. Choosing patience instead of impatience. Choosing discipline instead of emotion. Choosing preparation instead of reaction. Each of those choices strengthens the trader's foundation. Eventually, there comes a moment when preparation and opportunity intersect. The conditions are clear. The market confirms the analysis. The trend begins to move with strength and conviction. That is the moment when action is required. At that point, hesitation serves no purpose. The trader who has prepared properly must trust his method and act decisively. These rare moments are the ones that define careers. They are the trades that compensate for months or even years of waiting. But even then, discipline must remain intact. The market does not guarantee outcomes, and risk must always be managed carefully. The trader who succeeds over the long term is not the one who wins every trade. Such a person does not exist. Success belongs to the trader who manages losses intelligently while allowing strong opportunities to grow. This balance between defense and offense defines professional trading. Protect capital first. Wait for opportunity. Act decisively when the moment arrives. And always remain humble before the market. If these principles are followed consistently, progress becomes inevitable. Skill improves, judgment sharpens, and confidence grows through experience rather than arrogance. The market will continue offering opportunities to those who respect its nature. It will also continue punishing those who approach it carelessly. Your role as a trader is simple, though not easy. Study the market, develop your method, control your emotions, protect your capital. And when the moment arrives, when preparation finally meets opportunity, be ready to act with clarity, discipline, and courage, because in the end, the market rewards those who are patient enough to wait and wise enough to act when the time is right.